Right, ladies and gentlemen, so that brings us then to our breakout session. So as we have done in the last few sessions, Probe Audit Premium Plus users will stay in this session. But for Audit International, I'm going to give you a link now through which you can then join the second session or your breakout session and then go with Samu. I know Samu will be there. Some of the support staff will be there as well and support you through how to apply the risk assessment at assertion level in Audit International. For the probe guys, just stay here. We are going to do a few, well, look at a few points for risk assessment at assertion level in the probe methodology. If you want to follow along, you can also open up the caseware file that was part of the delegate material for download for today. But I will show it obviously on the screen and you can then follow along there and maybe go and try it yourself or test it yourself later on as well, whatever works best for you in that regard. So let's just give a few seconds or a little bit of an opportunity for the guys to join that breakout session. And then we will continue. Okay. So to join the other session, please follow the link in the chat. And of course, if you are a probe audit user, you will just stay here and we will continue soon. Right. Looks like a few of the users have moved there, so I will assume that those are coming right. Good. Okay. In our breakout session then for probe audit, session 3, which we have said is then the risk assessment at assertion level, we will have a look at the following. So firstly, I want us to consider what is new in this year's template. So the 2025-2013 template, that was the one that was released in November 2025. So that's the current, the most recent template that we are currently using in our firms. There are basically two big changes with regards to risk assessment at assertion level. The first thing which we will notice is a new button in 1051, which is called the Probe Optimizer. And that will remove the, I want to say irrelevant, but irrelevant is maybe not the right word. It will basically remove the content from work programs where there are no balances in the current or prior year, and also where those sections have not been activated in 1051. So we'll look at that just now. And then the other item that I will illustrate to you is in 1160, where we do the risk assessment, where we will have the opportunity or the option to mark or tick a section to be qualitatively material if it is not quantitatively material. Obviously, if it is quantitatively material, it's already been treated as a material section, but we now have the option, as we have in the past with related parties and commitments and contingencies. So some of those disclosure points, in the past we could mark it as qualitatively material. We now have the option to also mark another section, PPE, cash and cash equivalents, any of those sections, as qualitatively material, even if it is not quantitatively material. All right, so those are the 2 points that I'm going to show you, and we can then go to the caseware file to go and have a look at that. Good, I've already opened up the caseware file for us. I actually just want to quickly just see how I can make it even bigger, maybe right down. So there it is. So we've still got wrap-up manufacturing. This is a newer file that's just got a little bit of system descriptions and things in there. So, and of course, then the other thing, in order for me to show you the new what is the word? The new application or the new functionality on the file, I needed to obviously upgrade to the new template. Whereas the file that you would have used in your e-learning, that file is based on the older template, the 2024 template, because that's the one that goes with the recordings of the videos that you had. Right. So the content, the information, the case study, all of that is pretty much still the same. You will just see that we have added some content for this year, and then also those 2 new features or functions that we've added. Good. Now let me just get my bearings. Okay, so we did in the previous session, we did the risk assessment at financial statement or overall level. So there, okay, most of the 1120, those documents we had already addressed and discussed. For risk assessment at assertion level, you may or may not be surprised that actually already starts in 1051. So 1051 is where we start to look at the types and volumes of transactions. And if I open that document, you'll see that that's already where we start to look at the different sections. Right, so let's see what we have here. Or maybe let me remind you of some of the things that's set in this file. So in this file, as part of our planning, we had said that we do not want to have an overall documentation of the types of procedures that we performed to complete the documentation, to get the information, to be able to document the points. So here we had said in every section, so here we have loans to stakeholders, for example, and under that section we have the types of procedures performed and the individual that completed it had said they'd done inspections. And so you will have for every one of the sections, PPE, for example, we have types of procedures performed and the section completed. Each of those sections that are active will then have their own little block. The alternative to that was to say, I want to have one block only at the top of my document where I say which procedures that I perform, which risk assessment procedures that I perform. You will then tick inquiries, observations, and or inspections for everything that you had to do to get the content for this document, 1051. Right, so that is really just, I almost want to say, if you don't want to tick it for every section, you can basically do it once at the top. It's just a efficiency, I suppose. Right. That will be at the very, very top. So it's possible that where we now see this optimize button right at the top, it's not going to be right at the top. If you choose to only complete the risk assessment procedures once, then that will be even above the optimize. So that's why you might say, I'm not sure where this optimize button comes or is. I can't see it so easily. So now you can see with my mouse over it, that's where the optimize button is. So if you have your risk assessment block or table first, then just scroll down a little bit, you will see that button there easily. Okay, let's just quickly think about what is this about? Where does it come in? So, of course, there's a lot of content in the Caseware working paper file, and you already have a few other optimization options to make your files faster. One of them is to purge or to remove or exclude some information from the financial statements so that you don't have all of those notes in the financial statements. The other option was when you created this file, you said, I want to create a file, and what is the type of engagement I'm going to have in here? I'm going to have an audit. If you do an independent review, you selected an independent review, and it then removed all the irrelevant content from that file so that you can hopefully have a bit of a faster file. Right, so that was the second step. That's also new to this template, but we'd already addressed that in the earlier session because that's not at assertion level. The third option then is to say, once I've imported my trial balance, the software will then look at where do I have current year balances or prior year balances. If I have a section that doesn't have either of those, and then therefore the section is therefore collapsed and not active, like let's say the section just above that says loans to group companies, you might struggle to see that because it is blue on blue. So the contrast is not that big, but you don't have to see that as a user because it's not an active section, right? If I just quickly activate it for you, I'm going to enable that section just to show you it has no balances, right? You can see there's no balances. The table is completely blank. If I needed to have that section active, I would just simply go and enable the section like we see the enable section. I'm going to just disable it to make it blue again. If I wanted the section active, I would enable it. Now look what happened here. I didn't plan to do that. The moment you enable or disable sections, or if you import a new trial balance and therefore have sections that now have current or prior balances when they didn't have them before, you will have this yellow line at the top that says there have been changes to your balances. You need to optimize. Now, I normally or used to always train and say, whenever you see a yellow line at the top, you need to stop what you're doing and first fix that, because that is going to be a problem somewhere down the line in your file. Stop and first address it. So maybe my message wasn't always that strict, but it was, you need to pay attention to the yellow line. Okay. This here won't break your file. Your file won't be non-compliant if you have the yellow line. But what this says is, it says we have removed, well, we've noticed that some sections are now added to your file, or some sections have been removed from your file. And so we believe that it would be beneficial for you to now optimize your file so that the work programs that no longer need procedures in there can actually be optimized, can be made blank, so that you don't have extra unnecessary stuff in your caseware file. All right, what I want to just clarify or make very clear here is, if I had created the file as an audit file and it should be independent review, I can't fix it in that file. I need to then basically go and recreate the file and choose the right one from that optimizer wizard, creating the file wizard if you want. However, here, if I had optimized something out and now I've activated the section loans to group companies, I can bring it back in again. All right. I'm going to actually do that for you so that you can see how it works. It's really simple. It takes about 2 minutes. First thing for you to notice, if you click on the yellow line, nothing happens. You have to click on the Optimize button. All right. Now it's going to tell me to close my work programs, but okay, I'm going to carry on with it. So if I click on Optimize, it says, please ensure all work programs are closed before running the optimizer. Great stuff. Let's do that. And then it runs. It takes about, I mean, look there, it went very quickly, but obviously nothing's really changed in my section. So that's why it went really quickly. When I do this to a brand new file after importing the trial balance, I want to say it might take about 2 minutes. Okay, I don't even think it takes 2 minutes. So then it has basically now removed content from those work programs. There's nothing in there where there are no sections active. No current year balance, no prior balance, and I've not activated the section in 1051, enabled it. What does it say here? For a detailed report of what's happened, please have a look in your file, and you can see now this is literally where the file is saved. There's a text file there that says what to do. All right, so that text file will tell me exactly what's been done or not done in this optimizer. Okay, good. I actually want to, I don't want to now waste our time, but let's go and see quickly, if I just quickly scroll to those sections, literally just show you what one of those optimized sections look like. Oh, goodness, now I've scrolled past everything. Okay, let me just pick here, loans from, oh, there we go, loans from group companies. You can see it's now says optimized. Okay, there's a tag, if you use tags, but also the name of the document. Remember this work program has no section activated. There's no balance in the current or prior, and I've not enabled this section. So there's going to be nothing. So what do we expect to find? Look at this. There's not even a normal work program. You see, it's literally just a blank case view document. Okay. So that's the important part. That has really saved a lot of content in. In other words, it's not just hidden procedures in the background. The hidden procedures are, I almost want to say, gone, and you just have the a case view document, literally a blank case view document. Okay. So that's the optimization in 1051. Right, let's go back to 1051 still. And I then want to show you, firstly, for our first section, the loans to stakeholders. What do we see in there? So the first section that we're going to look at today is loans to stakeholders, and to see what's in there. So here we have opened up the lead schedule. You can open the lead schedule. Mine's now opened on the other screen. So there we go. And we see there's a loan account to S. Harper. Now, S. Harper is a director, so it is a related party. And we can then, having considered it then, having considered for this client and for this client's user, we consider related party loans to be quite a sensitive topic. Right, so we will go and consider this in a little bit more detail. In our bigger scheme of things, if you look at performance materiality, it's 800,000 Rand, for example. So the 134,000 is really not material in terms of numbers. Good. Let's see what the team has documented here. It says we inspected the general ledger for the loan. During the year, there were material movements in this loan account, and in the prior year, the loan was a liability. Okay, we actually owed the money to the director for the company, and this has now moved to an asset owing to the director. Large outflows of funds are noted in the ledger as well. So categories of stakeholder loans, stakeholder 3, they would probably say related party or something. And then in terms of risk assessment procedures, there were inspections done, inspected the general ledger for the loan account, as we've mentioned before. Then identifying possible risk of material misstatements. What risk assessment procedures did the team perform? In terms of reviewing the trial balance and accounts, we inspected the lead schedule and the loan account appears to be correctly mapped. Not just we saw it as mapped to loan accounts or something like that, but or if the the account name is correct or anything, we need to actually check that it is also correctly mapped to the loans. Okay, we didn't identify any unusual accounts from the lead schedule, and we performed the analytical procedures above to compare the balances per categories to previous years and see why it changed so much. So last year it was a liability, this year it is an asset. Review the underlying accounting records. The team inspected the ledger and no unusual, they didn't identify anything unusual, but this is a related party balance and it has moved between liability and asset, and therefore for the related party, for this client, again, not always, but for this client, it is now considered to be qualitatively material. Okay, we've already said number-wise, it's not material. Then let's evaluate the entity's accounting policies, that they are appropriate and consistent with IFRS for SMEs. Accounting policy in the prior has been inspected for financial instruments. The loans appear to be appropriately accounted for in terms of IFRS for SME. Okay, then we go. You would have seen this also on the recordings for the other sections. Then we go and we ask ourselves, right, were there any additions or increases in this? Well, it went from a liability to an asset. So the asset has definitely increased. And there it says there were a number of debit movements and the loan has moved from liabilities to assets. So now, through ticking the additions here, we have already kind of started to get ready to do more work in the work program. If there are 2 hurdles you need to get through. 1, the section is ticked in transactions and balances of this class of transaction or account balance or disclosure. And secondly, if the procedures that are linked to additions are also activated through a relevant assertion or a selected assertion. So relevant assertions for which risks have been recorded, and then selected assertion I'm going to illustrate to you soon. We also identified that this is a finance transaction with deferred repayment terms, that is, or where it could be below market related interest rates were charged. They don't charge any interest on this loan and there are no terms of repayment. So definitely then a finance transaction, I almost want to say with special terms. Hey? So that's been activated and the financial assistance is provided by the entity. This is a loan to the director. So this, if we look at the guidance, for example, this is a financial assistance in terms of the Companies Act. That is then to a director, point A. Right. Then the other blue items were looked at, considered, and not active. Right, so that's what we do in 1051. We're not going to look at any of the other accounts for now. I now want us to then move from 1051, the types and volumes of transactions. We're going to go to the risk assessment document 1160. We could also go and look at 1150, but I first want us to look at 1160. Well, actually, let's look at 1150. I'm going to show you what is currently there. Then we can see how it changes. So this is 1150 information system and control activities. You'll probably remember that we had looked at this for all of the controls or system descriptions that are necessary and where we needed to identify controls. So here, when we go and we look at the document map, you will see that we don't even have loans to, what is it now? We don't even have the section loans to stakeholders activated. You can see there, it's completely deactivated. Okay, so why is this the case? As a reminder, we need a system description whenever a risk has been recorded, whenever a relevant assertion has been identified. So this is possibly an indication then either I have not yet done my risk assessment, or two, I've done my risk assessment and I did not record or identify any inherent risks for this stakeholder loan, this related party loan. Okay, so let's then go to 1160 and see what we have there. So risk assessment document, risk assessment at assertion level. There we have the section loan to stakeholder because the section was activated or is active. How? Because it's got a current year or prior balance, or it was enabled in 1051. Right, it's obviously got a current year balance, so that's active. The team did not identify or record any risks for loans to stakeholders. So they considered the inherent risk factors and didn't identify anything that would have caused them to record that risk, any risk. Again, you could open up your lead and see what the balances are, but we already know that. We can see here that they did not record any inherent risk, no inherent risk. And then for cutoff, it's just not applicable because that's not applicable to account balances. What you will notice now, though, is that we now have a question that says, is loans to stakeholders qualitatively material? This is the new part for qualitatively material. So whenever a balance is not material, so the number is not material, not quantitatively material, and we have not recorded any inherent risks, there will now be a question to say, okay, but is this perhaps qualitatively material? Because if it is material and there's no risk, we need to stand back. Right, so I'm going to say, remember also in 1051, we said this is a material, qualitatively material, because it's related party and so forth. So we're going to tick that and say, yes, it is considered qualitatively material. Then I get this pop-up message that says you have assessed this category as qualitatively material. Consider whether a lower materiality threshold is appropriate for this category as required by ISA 320, which highlights that misstatements below overall materiality may still influence economic decisions of users. What is this one asking us for? Do you need to set a lower specific materiality? All right. Now, the way that Probe uses materiality, you set the overall materiality in the planning documents 1060, then you determine performance materiality, and performance materiality is then pulled through as your specific performance materiality in each section, automatically equal to the performance materiality. I almost want to say at overall level if you want. So what this is basically saying is, do you want to set a lower specific materiality than the overall 1 million and therefore a lower specific performance materiality for loans to stakeholders? We don't have to do that. So we can just say, no, it's not necessary. We stick with the 800,000, or we might want to say, yes, actually we want to, and then set. But our concern here is not so much about the number. It is about the nature and the circumstances of this loan. So maybe not necessary. And you can then document your reason and explain why you didn't set it as a lower materiality. Also, your reason for assessing loans to be qualitatively material, you will set there. All right. Good. So I just want to see that I've covered everything I wanted to explain. I'm expecting something else to also happen, but that I now realize is not going to happen in this section. The stand back. Stand back does not pop up here. The stand back pops up in the audit strategy document. Right, so we haven't recorded a risk, but we did mark it as qualitatively material. Let's go back to 1150. And this is the thing here. 1150 and 60 is almost like a dance. When the one steps left, the other one has to follow, and then the other way around again. So you always have to go back to the first one, whichever one you completed first, to go and check if anything changed. Let's see, has anything changed here? We can see that it updates. If you want to make double sure, you can always say refresh risk tables just to check, has this synchronized all the risks that were recorded, if all the settings and things that we had done. Just want to refresh this document to see if anything changes. Does take a while because remember, it reruns all of the scripts related to every single one of the accounts and sections. Okay, I'm just waiting for it to still run. Maybe not the best thing to do right this minute. Good. So now it's reset it and we can go and check again which sections are active. And when we go and we look for our loans to stakeholders, still that is not activated. That's actually what we expected, right? If you think about it, we have not recorded a risk, and only if a risk is being recorded does it become a significant loss of transaction account balance or disclosure. And only if I have a significant loss of transaction account balance or disclosure do I need to get a system description. So for loans to stakeholders, our related party loan, we still don't need a system description. Right, we've said it is material qualitatively, so let's go and have a look then at 1220. 1220 audit plan and strategy. Okay, it says we need to refresh, so we'll click and refresh. And the reason right now it says click to refresh is because I've opened up all the documents before the time, trying to save time so that we don't have to wait for all of these ones. But then when I do change things, sometimes it does still want to run the refresh just to check that we're not missing anything. So it's almost like it's telling you, you don't have to open it before the time I'm going to take long anyway. But I still like to just have them open it. It feels to me like it is still going a little bit quicker. Good. So what happens in this document is this is where we're going to set what is going to be in our audit plan. So here we first start off with the risk at financial statement levels. We had the risk at assertion level that we also discussed in the recordings where we have overall responses, or we're going to use management expert and so forth. And then we're going to see all the activated sections. So the only document that doesn't have all the activated sections is 1150 because it only prompts you for those where you actually need a system description. So here we'll go to our activated section, loans to stakeholders. We will see that the risk of material misstatement is currently medium 1 just because of all the other risks, but we don't have any inherent risk. Okay, we have not recorded any inherent risks for this section. Still nothing's changed because that would have been done in 1160. We now have this part that says select assertion for testing. But before we get to that part, because that wasn't there before, we still have specific materiality. We have desired audit risk as low. And then we have this instruction in red that says select at least one assertion for the material financial statement item. Material because we had indicated that it is qualitatively material. What we will also see is we now have this prompt that says stand back. Did we evaluate all evidence available to date and conclude that no inherent risks related to our section of loans to stakeholders were identified? So are we sure we don't have to record risks? If you get to this point and say, actually, you know what, I think there is actually a presentation and disclosure risk. What do I say? I can't say, did we evaluate whatever? You can't just, then you have to go and record the risk in 1160, and if I record a risk in 1160, it is going to open up the section in 1150 for my system description. So that's why it is critical that when I have a risk that I don't just tick an assertion here and just select whatever. I have to go to 1160, record the risk properly there, assess it for likelihood and magnitude, document my system description, and then I can come to 1220 and determine my audit plan. But if I've gone through it and I say there really is no inherent risk, then I can sign off the work program, because this also doesn't say, is there really no risk? It says, yeah, well, yes, it does say, is there really no risk? But at least have I evaluated? Because if I go back and I record a risk, this question will disappear because now you have identified a risk. Okay. I've concluded there really is no risk. And now I need to go and just select an assertion. All right. So what is the assertion that we would want to go and select? Let's say, for example, we are going to select accuracy and valuation in terms of whether it is recoverable, and then possibly procedures and disclosures even. So I can select more than one. That's perfectly fine. And once I've then selected that, I then get a question to prompt me, or that prompts me to say, why? What is the reason that you have selected these assertions? Okay, so you've selected those assertions. Please document your response. Why can I now not add something in here? Let me just see. Yes, that is my... Oh, I can actually document. I'm already in the field. Apologies. So what I would then document here is to say AVA and PD has been selected as selected for testing, as this is are the assertions. Woo. Most likely to be misstated due to the related party relationship. Remember, we want to document here so that any other auditor can always see, why did you do this? Why did you select that assertion or those two assertions? Why not something else? What happened here? Someone else should be able to follow your reasoning, follow your significant judgment, follow your professional judgment, follow your thought process, and understand what you did. So the next step to that is actually to say that once we determine why we identified AVA and PD, will actually then help us to determine, so if that is why I selected accuracy, valuation, allocation, and presentation and disclosure, then that will help me to determine how to respond, what procedures to do. Because the procedures that I need to do need to be responsive to the reason for the assertions, just like when the risk assessment needs to be responsive to the risks that I've identified. So then we'll say, as this is a related party loan, the disclosure are important to the users, not our users. The users are the financial statements, the loan terms, balance, and various transactions which have flowed through the loan account during the year. Okay. So that then gives us an indication of, why is this an issue? Why do we want to go and test those two assertions? And what you will also notice is that when I tick those two, I actually then got the required procedures tab or option selected, section rather, selected in my audit procedures for this work, for this section. So now, and this is also important, this really is a skill in terms of helping us to get this done efficiently as part of the planning process, is now to then follow this hyperlink under the audit procedures section to go and see what's going to be in my work program. What will I actually see when I get there? So don't just say, okay, now I've done the planning, now the other trainee can go and audit it. No, we actually have to go and see what procedures are activated in the work program, and therefore see if they are appropriate. The methodology has been developed to help you, to give you, I almost want to say, as many procedures as possible to see when you have selected AVA or PD or any of the other assertion classes. So I can almost bet you're going to have procedures that will be active in the work program that you do not necessarily have to perform. So what you have to do is you have to edit the procedures that are active or activated in this section, because there may very well be procedures that are not necessary, and we only have to perform procedures responsive to the reason for our assertions, for our risk. So let me open or just increase the size slightly. We can see the risks there. We can see there's no risk at assertion level. We can see the selected assertions. Then in the account balance audit procedures, we see some of the, I want to call it the generic, or let's say overall procedures that are always required when I'm going to perform procedures. So agree the amounts and disclosures presented in the current period to the trial balance, the general ledger, the loan register. So almost just checking that you are actually working with the right information. Then when you are using information produced by the entity, IPE, what did we say we have to do? You can see there, 500. We have to test the information is sufficiently precise and detailed for our purpose, and it is complete and accurate, right? And then also, whenever you're going to do selections, make sure that you select from a complete and accurate population. And then we have select material increases in loans and any new loans, and then all the procedures. And you can see all of them are AVA. This is the section or the list of questions that have been activated because we actually in 1051 said there were additions and new increases or new loans in the additions of loans and new loans or increases in loans. So that then basically activated this section of work procedures. Right. Again, you don't have to do all of them, but consider what you did think could possibly go wrong and go and have a look at them. Right. If they're not necessary, then you can hide them. How do you hide a procedure? Right click, ignore this procedure. Okay. How do you edit the procedure? Again, right click and just select enable editing. It then makes it a gray block and you can go and change it as needed. And when you're done editing, you just unselect enable editing. Other parts that we have journal entry testing for year-end adjustments and journal entries. We have presentation and disclosure or PD assertions, right? That's what we said is one of the points we have to test or want to test. If any of these related party movements are non-cash flow or are cash, we need to ensure that the cash ones are included in the statement of cash flow and the non-cash ones are excluded. So we also have those prompts there related to AVA. Again, edit as is necessary. And then you sign off on the work program. So we'll see that in the work program already only the AVA and the PD ones are activated. Of course, with journal entries, you've got the EO that's also linked to that same procedure, but you don't have an extra procedure, right? But you can definitely go and still edit those according to what you need for your work program. Right, so that is loans to stakeholders. Let's go and see how this worked for trade and other receivables, which is then our second section for today. Trade and other receivables, we have the balances, we have the lead schedule. If we look at the lead schedule, opens again on the other side. Accounts receivable, less provision for credit notes. Note that we only have trade receivables as the total, so we don't see the credit notes as a separate one. What we do see is that credit notes have actually decreased from the prior. It went from 125,000 to 29,000. Prepayments, few prepayments in there. Deposits stayed the same. Staff loans, it's actually overpaid. That's a strange one. And provision for doubtful debt has not been amended either. Right, what do we see in our analytical review procedures? The increase in the year does not indicate any concerns. It went from 20 to 24 million. The discussion with Andy Crack, the accountant, indicated that the increased sales near the year end resulted in outstanding balances. Right, so that's why the debtors is more at the end of the year. He's also indicated that there have been some returns of goods after year end, which were quite a lot higher than in previous years. And we will therefore investigate the provision for credit notes as the value has decreased year on year. You saw that value of provision of credit notes went from 125 to 30 or something million, 29 million. Then why, if they had so much more returns, that we not increase that provision for credit notes at year end? Right. Then the renewal of insurance indicates that there's a possible misstatement in the prepayments, but this appears to be trivial and will therefore not be raised as a risk. It is very small, and yeah, so that's less than performance materiality. We have bigger problems in the normal trade receivables. Deposits were not expected to change because the lease renewal that we are aware of only occurred after year end. So they wouldn't have made an additional lease deposit. And so it's quite normal and expected that deposits may remain unchanged from year to year. Other receivables, that's the staff loan, not trivial. Inspection of the ledger does not show anything concerning those sets, so that's fine, very small. And then in impairment, if we no movement in the provision for bad debts, which would have been expected because the revenue increase, the trade receivables increased quite a bit. A risk will be raised in the slide with the increase in receivables at year end. So that's our analytical review. You can see here that we have recorded some risks, and the risk assessment procedures performed was the discussion with Andy Crack on the 17th of June. We inspected the lead sheet, the customer age analysis and customer ledger. For prepayments, we inspected the insurance renewal, and of course, we performed the analytical procedures above. Then in terms of identifying possible risk of material misstatement, there's still a lot of discussions here. We've basically identified and already mentioned those two critical points, so that's fine. And everything documented in detail here to clearly document the considerations made. Right. Then in terms of the transactions and balances, again, an increase in trade receivables. So we've added that there was an increase in trade receivables. We're going to activate the provision for doubtful debt because that's something we want to focus on, as well as there needs to be a provision for credit notes. And of course, they have it, but it's not big enough. So we're going to see whether risks have been recorded. Otherwise, you could always have gone here and recorded the risk for trade receivables. Okay, where is my trade receivables now? There we go. And you could have gone and recorded it. All right. The accounting estimates, what estimates are there for trade receivables? Well, the provision for bad debts is one of the estimates, and you can see there that you also then have the instruction to go, or the reminder if you want. In terms of the software, we call it instruction because it's red. It tells you have to go do this. So a reminder then to say, go to 1053 and go and document your understanding of the accounting estimate of this trade receivables one. In terms of transactions directly related to accounts balance, to the trade and other receivables, so the TRAB, if we refer to it like that, is of course the impairment in financial assets, and that being the provision for bad debt. Right, so that's 1051. I'm going to just close it, and then we can go to 1160. First of all, let's go to 1160, the risk assessment document. When we then go to trade receivables, good. There we can see we've already recorded two risks. The first one came straight from 1051 and the other one was added in this document. Firstly, talking about the returns after year end and the provision for credit notes that hasn't changed, and the assertion, accuracy, valuation, and allocation. So the value of the provision, therefore the value of the trade receivables balance, because that's the section that we are looking at. The likelihood, the monetary impact, inherent risk was assessed as medium, not a significant risk, right? But it was a medium inherent risk. Then the debtors that may also not be recoverable because it's increased by so much, and you can see also that it is a material balance. Inherent risks, therefore, AVA is medium. Both assertions are medium. The highest one is pulled through. And we could have also have given a reason description there for specific materiality. But that's 1160. So the risk that we're going to work with and that we are going to respond to in the work program is the medium risk for AVA due to the increase in the balances outstanding at year end and the provision for the provision for doubtful debt because of the increase in the balances, but also the provision for the credit notes. All right. Then when we come back, now 1220 is at the back all the time, but when we then come to 1150, the information system, remember, whenever we've recorded an inherent risk, we have a relevant assertion and we have a significant class of transaction account balance and disclosure. And therefore, we then have to go and document the system description. And so you'll see here the trade and other receivables section is activated for that. And you have a lovely system description there of how the transactions are initiated, recorded, processed, corrected as necessary, and incorporated into the general ledger and the financial statements. You have considerations of events or conditions, accountability of the related assets, integrity of the data, how that is maintained, all of those things. The XXX that you're seeing are all the pretty system descriptions. We do not have to test controls, so we don't have to identify controls just because there's a risk. With significant risks, we have to, but this one is not a significant risk. So we've documented our system description and therefore done what we needed to on 1150 information system and control activities. Good. Then when we go to the audit plan and we go look at trade receivables, we see the AVA risk of material misstatement is medium 1 or medium 2, apologies, and the inherent risk assessment obviously coming through. You could still select assertions for testing, but you don't have to. All right, there's nothing that says you must or should or whatnot. So yeah, again, if I want to now randomly select an assertion, I'll definitely ask myself why. Is this perhaps because there is another inherent risk that I should rather go and actually record? Or why am I just selecting an assertion? Yeah, almost doesn't make sense. Because it's not significant risk, I don't have a significant risk response. I did not consider controls, so I can't test controls. I therefore, at this point in time, only have required procedures as a response. I do have to also indicate which procedure or which response I'm going to have for accounting estimates. I have the option to evaluate events after reporting date, test management's estimate. In this case today, we are choosing to develop or calculate our own estimate of what should be the provision for credit notes and our own provision of what should be, own calculation of what should be the provision for doubtful debt. All right. Let's look at what this work program is then going to show us. If we open up the work program, which procedures will we see there? Just want to give it a moment to open up. I will come back to 1220 just now to address that. I just want to say those random medium ones for where we haven't recorded a risk and why those ROMs are still showing there. So I'll show you that just now as well. Good. We've got the account balances. So again, firstly calculating the average debtors days, part of our procedure still. And then we've got those, again, the current year financial statements followed through to the trial balance and so forth. We've got the information produced by the entity when you're going to look at maybe the debtors age analysis, things like that. And then when you're selecting items for testing. Then we have obtain an age analysis. I actually want to increase the size slightly because even for me, it feels a little bit small. Then we have obtain an age analysis of trade and other receivables at year end with comparative figures and then start to work through comparative figures for the prior year's working papers, investigate unusual, inquire about unusually large receivables, considering really AVA. And these procedures could sometimes maybe be, you might say, but why do I have these? Remember, we can edit the work program as we need to, but our risk is the trade receivables balance is quite unusually large at the end of the year. We need to see if there doesn't have to be more provision. So probably you're going to find that a lot of these items are actually relevant to our risk that we've raised. Right, so you'll go through these, check which ones are relevant. We've got material debtors with credit balances. Maybe that's not necessarily relevant, but again, I mean, that might even make it smaller. Material receipts from the general ledger, if you need to test those. Material sales transactions from the debtors control. These ones might rather be testing for. Understatement, perhaps. Inspect the list of trade receivables, confirm that it is in terms of IFRS for SME. All right, that they're also not offset, and then material receivables, and then comparing it to monthly statements, things like that. So consider whether these things are necessary, maybe hide them if they're not necessary. There are quite a number of procedures for accuracy, valuation, allocation. Then estimates, there we said we are going to test our own estimates. So the procedures that appear in the work program will say for all estimates, including fair value, where management's accounting estimates are tested, determine your own method for testing, determine whether changes were made to the method, and so forth. So let me just quickly check that I tick the right one now. I'm going to go back to, I opened, I'm expecting rather to see, yes, we're not testing management's expert, we are testing our own expert. So let me just see. Normally what we would find actually is the other procedures. Maybe it's going to refresh now. Where management's accounting estimates are tested. There we go. So I actually think these ones shouldn't have been activated. Let me just quickly refresh the work program. So now you can also see how you can check if it's appropriate. So I just want to switch them on, risk tables. I intentionally don't fiddle with files that I'm going to train on so that I don't have surprises and that I don't have refresh problems, because sometimes when we are testing, we look at these things and see that the right stuff activates. So there it is, where management's accounting estimates are tested. Those are the procedures. Then develop the auditor's point estimate. Consider the need to obtain representation. So yes, now what I'm going to do, just to show you, I want to switch that one off actually. So I'm going to go to 1220, switch off testing management's estimate, which is what we had before as well. Now I'm going to refresh, and my expectation is that now we shouldn't have this part that talks about testing management's estimate. What I could have also done is I could have literally just gone and said right-click, ignore procedure, right-click, ignore procedure, right-click, ignore procedure. It's still there. Okay. I don't want that because I've said already, I'm not going to test management's estimate. So I can literally go and say right-click, enable, ignore procedure. If I don't want to test that, I want to test. I'm not worried about management's estimate. I want to test my own one and check that. Okay. So you can decide what would be best. We want to just check that management has correctly done the provision. Then we've got the journal entries. What's happened with my document map now? Everything seems to be moving. With my journal entries, identify significant unusual year-end adjusting journal entries. This is, of course, journal entries because of risk of management override. Okay, and possibly one where management can do exactly what we see as a risk, possibly override the normal controls for providing for trade receivables by processing smaller journal entries than what should have been done otherwise. All right. Then we have the conclusion of the normal risk of material misstatement and all those things. And then when we get to the provision for doubtful debt, the impairment testing for trade receivables, ensure the impairment loss measured at amortized cost is measured at the right amount, impairment. So this will be the total, basically, expense written to the income statement, whereas the balance sheet impact is, of course, under the estimates. Right, and the reason why those are all in the same work program, even though the income statement effect will be in operating expenses, is because this is all tested together. The net difference between last year's provision and this year's provision is obviously what goes to the income statement, so you're basically testing them all in one go. Right, I haven't looked at the chat or the questions for quite some time, so let me just see if there are any questions. Okay, I don't see any questions. What I am going to do now, though, is then to say thank you very much for your participation. I realize now, ladies and gentlemen, that the QR code here is the previous session's course evaluation that we obviously don't need. So I've just removed that for us quickly. We've already done the course evaluation, of course, earlier today. So yeah, that brings us then to the end of session 3, level 2, planning the audit. And with that, I want to thank you for your participation. Thank you for your attendance. And a reminder, the material will all be available, will stay open. The recordings will be added to the Success community. So please, if there's anything that you still want to revisit, revise, listen to again, or listen to in the first place because you're now curious, go and use the resources that are available to you. So thank you and have a fantastic rest of the day. Goodbye.